Good evening, everybody. Tonight we've got the special honor of having Andrew Giovinazzi with us. He's been an option trader, not only an option trader, but worked at one of the market makers on the CBOE. So I'm going to let him tell you all his background. But he has 25 years of option trading experience, so I think you're going to find his information very good. So with that, Andrew, welcome to the Candlestick Forum. We're anxious to see your information.
Thank you. All right. My name is Andrew Giovinazzi. I was a market maker for 15 years from 2000. Oh, my gosh. From 19. I forgot how old I am. From 1991 to 2006. For the last 6 years, I've been with Mark as the Chief Operating Officer of OptionFit.com. For the last 3 years of that, I've been the risk manager for our hedge fund, Carmine Capital LLC, which is a VIX-based hedge fund. I also manage all of our pro mentoring, product development at Option Pit for helping people trade options better and faster. And I'm writing our new Volatility newsletter, and I'll be teaching our new VIX Made Easy course. This is the intro for that course. And I don't know, I guess I've traded probably 6 million option contracts in my life, maybe 6 or 7 million. So I have seen a few things with options. So here is our introduction to VIX. I believe at the end, Steven says there's a 10-minute section for questions. So hopefully you'll learn something. Anyway, this is our take on VIX, and basically just what is it. So what are we going to cover? What the VIX is and what it is not. I think that's the most important thing, just getting the misconceptions out of the way of what that product is, what it measures. Also, it's hard to talk about VIX without talking about the nature of volatility, so I will make it in as simple way as possible. Also, trying to look at the SPX straddle for an easy VIX. Trying to figure out or divine yourself, if you're trying to figure out how to trade VIX as an up or down, you want to know where it's going. So where is a place to look and understand where VIX is going? So my idea is the straddle. That's one of the simplest things I use to help me. And then at the very end, how to trade VIX profitably. And I'm hoping that's how you spell that word. It is. And with that, we're on our way. First off, what is it? The VIX is just like anything else. You can chart it. It has end-of-day prices. It prices during the day. It's something you can follow. However, one thing you notice about the VIX is just looking at a graph of the movement. It doesn't move like normal products, right? It goes, it seems to have kind of a floor. It seems to go up very fast and can come down pretty fast. It doesn't go too high, but it does move up, and it can move up rather abruptly. So all of that there's a nature to the product. So if you're buying VIX for it to go to 200, that's a tough one. If you're buying VIX to go to 2, that's a tough one. So the thing with actually trading it as a product is it is very limited on where it can move. That's the first thing you have to think about. So when you're trading it, you think in your mind, what's possible, what's probable for the volatility index? Okay, what's probable for the VIX? So when I teach, and when I teach our pro clients or doing some mentoring sessions with people, the first thing you have to remember about it is what is possible, what's probable with VIX. So that's what this session is going to go through a little today, understanding what it is, and then keys to how to trade it, and maybe use that for looking at the other volatility products like VXX and VXY. Okay. So a couple things. It hasn't gone below 8% or above 100% since 2008. So you have a range, although it's quite a bit of a range. A lot of you probably, if you're active in the Candlestick Forum, you probably have some idea that VIX has not had much of a year this year as far as how high it's gone. It's been a lot of the year in the 9s and the 10s, which historically I believe it's the lowest year on record for volatility in the market. Another thing is you can't buy or to sell it. Has anybody tried to buy or sell VIX? Have you been successful? So the answer is, my guess is you might have tried or thought you tried, but you can't buy it or sell it. I don't even think Goldman can invent an index that matches it. It's very difficult the way it's constructed. So as an index, you actually can't trade the VIX itself. So that's the first thing. So anytime you trade a product based on the VIX, based on anything remotely related to the VIX, you're not trading the VIX. Okay? What the VIX measures changes every week. By that, I mean the weekly options that price the VIX, those change every single week. So the idea about it is to create kind of a smoothing action for how the index moves. It doesn't measure fear or complacency. I know that is a common, like a CNBC-ism, where it's what the fear index is, what it measures. Is it measuring fear or complacency? It doesn't measure either of those. But we will tell you exactly what it measures. The long-term average for VIX is around 20, but the mode for VIX is around 13. When I say the mode, that's a statistical word, but it's just where are the most samples for VIX, right? Around 13. So even though the long-term average can be high, as in 20, we're trading around a 1030 right now. VIX spends a lot of time below 20. But when it gets above 20 and the market starts to rip around, especially 2008, 2011, 2012, the index can stay pretty high for a while. Okay. Here's another thing. VIX options and VIX only settle to cash once a week. So what happens is there's one brief moment in time where the VIX settlement actually matters. That's on Wednesday morning on the first print of VIX. And then after that, I know it's kind of strange to think about it, but it doesn't matter anymore. It only matters once a week, every week on Wednesday morning. So again, trading VIX, trying to trade the options, trying to get the options to draw to the cash index can be very frustrating for people that are looking at it the first time. Right? The VIX index itself, right, as an index of volatility, an index of numbers, it's generated from all S&P options in the target terms that have a bid and an offer. So literally hundreds of option series make up the VIX. Okay. Also, the last thing to mention, at least just VIX facts or quick VIX facts, is VIX is calculated in minutes every day. So you have a change in volatility, you have a change in option prices, VIX is recalculated, VIX is recalculated, it continues to recalculate. So the thing is, it is a very live index. Okay, so it might not be tick by tick like stock. And also I think the trading in VIX does not lend itself to tick by tick trading. It's a slightly different product. The underlying is different. What it looks at is different. To me, in my mind, VIX is more or better as a swing trade product, something where you're looking at it like 2 weeks, 3 weeks, right? 1 week, 2 weeks, 3 weeks. It's very hard to, sometimes it can be an intraday product, or the products around VIX can be an intraday product, but mostly it's a swing trade. And if you go back here, if you just look at the chart, you kind of notice how VIX trends. The big moves tend to take weeks to happen, right? A week to go up, a couple weeks to go down, a week to go up, a couple weeks to go down. You kind of notice once it gets a little momentum, it starts driving, but it takes a while to get there. So when I'm looking at VIX, right, and I want to, in my head, I'm looking for when is the momentum going to pick up in volatility? Because that's when it starts to trend. Notice how strong the trends are in one direction once it starts moving. Right? So it can be a very powerful trending tool. Okay? Note the nature of how it moves, how sharp the increases are when it wants to increase. So those are all things I use trying to trade it, understanding just what that cash can do. Okay? So let's get to exactly what it measures. Okay? So if you trade VIX, what exactly are you getting? Okay? You're getting the implied volatility, the 30-day implied volatility for the SPX. So VIX is looking at options expiring 30 days from now. So if you were, for instance, if you were looking at a time in early October, you would be going 30 days forward in October all the way to October 30th. VIX would be looking at options way out here. VIX is not looking at options on October 11th. Okay? VIX is sampling options a month away. So that's really important. So if you're looking at VIX right now, where are the options pricing around Christmas? Where are the options actually pricing? So the index takes its value from options that are going to expire in early January. Somewhere between 23 and 37 days to go before expiration. So trading VIX, number one, is what you're trading. The most important thing about what you're trading is not what's happening now, it's what's happening in the future. 30 days to go specifically. So that's the first thing that's important. Understanding the calendar, understanding what's going on with VIX in general, and what you're trading. So if you think volatility or VIX is going to, or let's say just volatility in general, is going to collapse in a weekly option, as in stuff expiring next Friday or tomorrow, VIX is not going to be the product that's going to get it done. So you could be right on what's happening with volatility, but you're going to be wrong on the product that you choose. And probably the first thing I hear from clients is, I thought vol was going to do it, I saw vol do it, but the VIX didn't do what I wanted. That's frustrating for people. Mostly they're not looking at the right place. So as far as if I would give the biggest trick about VIX is make sure whatever you want to happen with volatility, you're looking in the right place. So if you have volatility opinions for VIX, you're looking at 30 days out. If I could put a red blinky light on this slide, I would. So VIX is measuring options 30 days out, the implied volatility of options 30 days out. That's important. So right now, if you're looking at volatility, it's starting to price after the holiday volatility. It's not pricing Christmas, it's pricing after Christmas, just getting into the new year. So somebody like me, again, who's more of a kind of a swing trade when it comes to VIX, I'm looking at volatility that is after the holidays, that could be starting to pick up the beginning of the year. So that changes the idea or some of the concept I have on what could happen to the index. Basically, I think there's a floor on it. Okay. Here's a couple things with VIX, and this is another important thing. VIX is a volatility direction, 30 days out, but it doesn't compound like a stock. So Apple compounds, right? Black-Scholes, the model for Black-Scholes depends on compounding. So the option model is we're going to get dividends. It assumes that a stock is going to be higher in the future than it is right now. Okay? Volatility does not trade like that. Volatility reverts back to some mean number. It can't go up forever. It can't go down forever. So the nature of VIX, when you're looking at it and looking at it to trade, like I said, somewhere close to the beginning is, what can I expect? If you're buying 30 calls in VIX for tomorrow, okay, you would need the options in January VIX to have a massive move to get to that number. It doesn't mean it can't happen, but that's what needs to happen in order for the index to climb a lot higher. It makes it really, really tough. So the important thing about the product is what is really possible with VIX and what's probable with VIX. And I think that gets a lot of people stumble. So if I define it and define volatility, what is it? Basically, volatility is just the range of a stock over a certain period of time. So when I say that is, how much can a stock move in a day, a week, or a month? So a 1% move in an underlying stock is a 16 volatility per day. Think about that. So if the VIX is a 10 vol, right, it's assuming it on average that the S&P 500 is moving at less than 1% per day. So when you look at VIX specifically, all we're talking about is the SPX. So all VIX is measuring are SPX options. It's not measuring Apple or Russell. There are other indexes for that, other volatility indexes for that. It's not measuring the Treasury index. It's only measuring what's happening with the SPX. So already you're starting to see some limiters on volatility. It's 30 days out. It's just the SPX. So you're looking at something that's extremely narrow on what it measures. So now looking at this way, let's start to put some numbers on it. The way Black-Scholes works is it looks at an annualized volatility. So when the typical Black-Scholes model of how to create a theoretical price for an option looks at 1 year forward volatility. Nobody in this room right now, at least not that I think of, knows what the forward volatility is going to be between now and a year from now. We don't know that. You can guess, but you don't know it for sure. Black-Scholes wants that number exactly. Okay, that's an important thing to figure out. So what we try to do now is take what Black-Scholes wants and we sort of back out with what we have. So a lot of what you do with volatility and trading volatility, trying to measure VIX, is break down for the period of time that we're looking. What is a possible volatility trade between now and Christmas, right? It's hard for Black-Scholes to really model that because it's looking for an annualized volatility. All we can do is look at local volatilities from now until Christmas time to make, let's say, some sort of volatility trade. Okay, but the idea is volatility is a number, meaning how much is something going to move. So if I said a stock has a 15% volatility and the underlying price is $100, from the model we can say a year from now that would give us a range from $85 to $115. So with a 68.2 or 1 standard deviation degrees worth of confidence. So when I look at a straddle on a $100 stock a year from now at a 15 vol would have a range of about $30. Even though you only have a 15% volatility, the straddle range is $30. It's $15 down, it's $15 up. So if you start to look at it and think about a straddle, what's a straddle actually doing for you? Okay? It's approximating the market's best guess for a move. So anytime you're looking at a straddle, or if I tell you a year from now, where's that $100 stock going to be? I can't tell you what price the stock is, but with a high degree of certainty, 68.2 degrees to be precise, I can tell you the stock will be somewhere between $85 and $150. So our next step as you kind of move forward trading options is, all right, now what are the options doing? What are the options pricing? What are they telling me? So you can approximate volatility looking at the straddle for 30 days. If you see the straddle out of value, it's giving you an idea of what's happening with volatility. And again, the reason being is if you look at it, you have with a high degree of confidence, you can see a $30 straddle generates a 15 volatility. Think of it backwards like that. Right? So when I'm looking at VIX, I'm starting to think, or if I'm looking at the SPX, I'm looking at a 30-day out straddle, and I think to myself, what can that straddle do from here? Okay? What is the possibility and what is the potential? So if this straddle moves around, what's going to happen to VIX? What's going to happen to volatility? Paul W. is saying with a 95 degree of confidence can be found taking 2 standard deviations to fit a normal distribution. That's right. So that, Paul W., is additive to this. So if we went from $30 up and $30 down, that would be 70 to 130 would be a 95% degree confidence level. And where that range would be, that would be 2 standard deviations. And then 3 standard deviations would be $45 down, $45 up, and that would be what, 98.2% or 99.2%. Pretty high. So the idea is using the straddle, and this is kind of what I posit as, this is my opinion, it's Mark's opinion, it's how we look at straddles, but the straddle of anything for a period of time is giving you the market's best guess of where the range of the underlying is going to go. And we use that information a lot. So instead of trying to guess where the market's going to go, which is kind of hard sometimes, right? Maybe for Steven it's a little easier. But for volatility traders, I'm looking at the straddle and I'm thinking, is it going to expand or is it going to contract? So my world starts to shrink, especially when we're talking about VIX, is in my head I'm thinking, if that straddle's expanding, the implied volatility should be going up, so I'm expecting VIX to go up. Okay. So what we use now is if we now take the implied volatility of our straddle, that's giving us a high confidence estimate on what the market thinks is going to happen at any particular time. Now here's a test for you. I use SPX. Can you guys still see the screen like this? If I use SPX and I'm looking at a December 15th cycle right now, I'm looking at the D's 15 2640 options. The straddle's $24. Are you guys seeing the live vol screen up there? So the straddle price is telling me the market's expecting around a 1% move between now and when? Right? December 15th. Does this calculation have anything to do with where the VIX is priced right now? If I'm asking you that question, does this D's 15 straddle have anything to do with really where the VIX is priced right now? The 20, here's the straddle prices right here and right here. Right around 24 bucks. Okay? Frank's saying no. It's not, because VIX is looking out here somewhere, right? VIX is pricing options way out here. This is only what I'll just call tangentially connected to how VIX is pricing out here. Right? This is not going to go in the calculation. So if you have an opinion about the D15 straddle, you really want to go and attack trading VIX. So if you have an opinion about this straddle, are you going to trade this D15 straddle tomorrow to try to affect the, if you think that's going to affect the cash index, right? The answer to that is no, because the options pricing for VIX are way out here. Okay, this would be a totally different trade. You could trade a butterfly, you could trade an iron condor short term, but VIX will not be the way to approach any opinion you have about this straddle. And I think that's probably the biggest misnomer people have. Because you think about, wow, this is close to the holidays, you know, you got Congress, you have all these opinions, right? And I think they're going to kill this straddle, and we're not going to get basically what it looks like right around a 1% move, right? If I do this and I say, okay, let's get our, where are you? There we go. Right. I have a straddle priced here at just around 1%, a little bit less. Okay, so the VIX ship has sailed for the D15. You have to attack this a different way if you want to trade volatility in the short term. Okay. So when I look at this, if I go out and I look at a straddle, so let's say this is the January 3rd straddle at this point. If I'm trading VIX, I'm hyper-focused on the 30-day out straddle. It's around January 5. I think we can get a weekly. Let's go to January 8. Okay. So the 2640 straddle is trading for about $26 here and 23, let's call it 50 bucks. Right? That's about a little less than 2%, right around there. So here's the thing. If you think VIX is going to stay within this move within 50 bucks, or I'm sorry, the straddle is going to stay within 50 bucks, VIX will be flat. Okay? Because every day that goes by, right, the straddle will decay away. Does that mean VIX cash is necessarily going to decline? So if I ask you the question, this straddle right now is $50. If every day that goes by the straddle declines because of decay, does that necessarily mean VIX is going to go down? Yes or no? You got a 50-50 shot. No, I think that's right, Frank. So the straddle can decay every day. The price of the straddle can go down, but time to expiration is decreasing. What you're looking for is if VIX is going to actually decrease, this straddle has to contract more than it's going to decay on a particular day. That will give you compression of VIX, right? VIX will decline in value. The way that this straddle, if this straddle starts to increase more than the decay says it should, right? Because every option decays everything. Then you actually have an increase in the straddle value in one day, much more than the decay says it should go. And that will say VIX should start increasing over that period of time, or the actual index will start picking up a little bit. Because if this straddle is increasing, what's happening to every other option all the way down the chain? The 35 puts, the 25s. What's happening to the volatility in every single strike if this straddle is increasing in value, which is growing and growing and growing? Right? All the options are going up with it. That's correct. So by looking at the straddle, it's giving you an idea of what's going on. So today, if you're looking here, there's a measure in live vol just called sigma, right, where this is the Jan '08. Volatility on average through the term dropped 74 cents. Okay, right around $0.75. Okay, VIX today is down around 86 cents. Right, kind of a bloodbath for VIX. And the reason why this number is a little different than this average is because the downside puts are weighted a little more in VIX, which means a drop in your downside puts will push this down just a little bit more than this average right here. But in general, looking out here, looking at the straddle will give you a trend for this. So here's another way to think of it. So if the straddle is increasing, how about all these puts? What if the value of all these puts starts increasing? Again, market's not doing anything. You're standing here on one day, and the value of all these options increase. Right? The volatility of all these puts are increasing. Right? What's going to happen to the straddle? It's going to go up, and VIX is going to go up. If somebody comes in and buys tons of these puts, they buy thousands and thousands of the 2605 puts, right? That's going to start to push those options up in price, which means the implied volatility is going to go up, and VIX is going to go up, right? That will make this straddle increase. So a trade here will affect a trade here, pushing VIX up overall. So when people start to panic, what happens? So when they say it's the fear index, right, or the greed index, if some panic or worry starts to go into the market, right, where everybody in this room say, I'm buying puts right now, what do you think all that put buying is going to do to the value of these options? It's going to drive them up. These options are going up. The straddle's going up. VIX goes up. So the reason why they say is what VIX really is, it's a supply and demand index. You want these options, the price is going to go up. How the price is measured is going to go up. It's going to drive the straddle up. VIX is going to expand because all of these options are expanding in value. The market cannot be doing anything, but VIX can jump. So here's another example. Right, which I thought was a pretty good one. It just happened recently. You guys remember this day on Friday? The news hit the tape, and VIX went from 10.5, I think, to almost 15 in about 15 minutes. What do you think was happening to the option prices? And I'll give you a sample. How much does that actually have to move the option? Oh, come on, option prices. Come on up. There we go. So for the volatility to move 4 points, and I'll give you a sample here. Let's go out. Okay. The value of the straddle, a 1 point move in the straddle, I have 295. I have about 600 Vega per straddle. That means for every 1 point move in volatility, the straddle gains $6 in value. Right? So 295 Vega just means for every 1 point move in volatility, the option price goes up 295 bucks. So for the volatility move from 10 to 14, that's a 4 point move in volatility. I have $6 per volatility point, 6 times 4. So the straddle gained $24 in about an hour. So the January straddle went from where it's currently priced around 24 bucks to around $48 in an hour. Much more than the market actually moved. I know because I was watching it. Pretty intently, actually. I'm like, wow, this thing's really moving up. So one of the easiest ways, if you want to start to learn to, let's just say, estimate where VIX is going, or where it can be going, is understanding the term that it's looking at and what's happening with the implied volatility of those options. Okay? What's happening with the straddle value? That's going to give you an inkling into what's happening. So why does VIX or why does volatility collapse into the holiday? Think about it. You've got options, a $50 value on the straddle that's going to expire in a month. And if nobody thinks anything's going to happen, all of a sudden the market starts to think, exactly, there's low demand. So everybody's saying, we're not going to have a 2% rally in a month. Maybe we'll have a 1%. So all of a sudden, instead of the $50 straddle, now you're thinking like a $45 straddle or a $42 straddle with a month. That will continually compress the straddle rapidly, driving VIX down. So what you're thinking of is, when can VIX really expand is really driven by what the market feels is going to happen at that time. So if you're trading VIX and you're frustrated, that might be part of the thing. The first thing is you got to get some idea of what the index is. That's why I say it's very hard as a, what I would call a day trade, something you enter in the morning and get out in the evening, or even intraday for like a 1 or 2 hour trade, because that's not the nature of how VIX works. Remember, it's a 30-day option. It's way the heck out there. It really is meant to be traded on a 1, 2, 3 week time frame, not a one-day time. Very difficult unless you have something really crazy happening, and that's what I just tried to show you. You know, you start getting some kind of a crazy move in that straddle, and VIX can move, but you need that to start happening. Okay? So what I just tried to show you and describe is that VIX moves when the implied vols of the options. I can't stress that enough. So when your straddle's contracting, VIX usually drops. When your straddle's expanding, VIX usually increases. Because all the options connected to that straddle generally do what? Right? They ride with the straddle. So a simple way to follow the performance is the sigma in the SPX. So you might have, you know, a toss platform, the sigma's on the right. In live vol, it's kind of set up as, I actually know the guys that invented live vol. They created the product in my pit when I was on the Picos. That was, live vol platform was built around the way a liquidity provider market maker. Andrew, it might help to define a straddle for this audience, the majority of which invest in stocks. Thank you, Paul. We can take 2 minutes to describe what a straddle is. Sometimes I keep forgetting that not everybody's been trading options forever, for their entire adult life. Let's see here. There we go. And let's get this. And clear all my sims. And here's a straddle. So what is a straddle? A straddle is just long a call and long a put, same month, same strike. Okay? Generally, call and put, the volatility rides together. So the implied volatility of the call and the put are going to ride together. The profile looks like this. So you go, woohoo, if the market moves, you make a lot of money. The thing that you have to give up, though, is decay. So right now what this says is, if you buy the Jan 2640 straddle in the SPX, it's going to cost you $50 a day. That's what the theta means. The sensitivity to a change in volatility is about $400. So volatility goes up a point, you're going to make $400. Volatility goes down a point, your straddle will lose $400. So what you want to do is you just want to see some action. You want to see the underlying move a lot. So to the extent that this straddle changes price, and I have here 46.35, right? So if nothing's happening but this straddle's increasing, right? The cost of the options are going up. That makes VIX rise. If this straddle value is going down and nothing's happening in one day, what's happening is that those options are decreasing in price. The options around it are decreasing in price. The implied volatility of the option is decreasing in price. Everything is going down, VIX goes down. Okay? Here's your sigma. So what this is this is just an average volatility for the term. So in live vol, sigma is the at-the-money option, 3 puts and 3 calls. That basically it's just this little piece right here. 3 calls out of the money, at the money, your straddle, and 3 puts down. Remember, VIX picks up every option in the terms with the bid and an offer, literally hundreds and hundreds of options. So what your sigma is just kind of an estimate. Now, here's the thing as we get to 842, and you probably had all of the vol that you can handle, and just when you think you have a sense of it, the SIBO, and actually I know the guy that helped develop the product, Dominic, who was a DPM in there a long time. All the voice is fading in and out. I'll try to talk louder. It's hard to believe I used to be so loud on the SIBO. I can't believe I don't think I have a voice left anymore. Right? So positioning and trading VIX is a game of pricing the straddle, like I said. It's important. If you think the movement range will decline, VIX should decline. If you think the movement range will increase, VIX should increase. So the important thing is what you're taking is a range and turning it into a direction. So when you're looking at VIX, if I think that straddle range is going to decrease, whether up or down, right? Because the market moves down a little bit or just up a little bit, I'm expecting compression of the options. VIX will go down. So the one thing that once you kind of get used to VIX a little bit is the market could go up a little, the market could go down a little, but VIX can still travel in one direction. That's the fun part. If you think the market range will increase, as in, the market starts to blow up, VIX will increase. The problem is, as retail traders, and just about everybody else on the planet, you can't trade the index. It's really annoying. Now, part of like mentoring and stuff is I teach people how to trade straddles and actually trade the physical volatility in the SPX, right? Those are condors and butterflies and stuff like that. But we can't trade VIX. So like, well, why do we go through all this trouble? Because there are futures on VIX. And the deal is you could trade VIX futures and VIX options with the settlement every week. Now this is the part that's going to be confusing to you, but it's what it is. So I have a VIX that is a 30-day out underlying. Right? Remember, VIX is a 30-day out underlying. But all of the local futures, meaning the futures priced around what's happening this week, settle this week. So all of the futures that trade, they settle every week on Wednesday morning. You have a future pricing what's happening or settling for VIX now, but it's pricing something that's happening that is using a 30-day out index. So what happens is all your VIX futures trade at different prices relative to where the cash is at any one time. So I have, on this day, I think VIX was trading right around 10 bucks. Okay, 10 bucks. The October, the spot future at the time, the OX17 future was trading 12.13. It was trading about $2 over where the cash is. The future expiring 6 days from now is trading at 10.80, about 80 cents over where the cash is. The future is trading 11.45, 13 days. The active, or I guess what we'll call the serial future, was trading at 12.13. It was about $2 over where the cash was at the time. The problem is all these futures are trading at different prices relative to where the VIX cash is. Now we could look at that now. Okay, I think we VIX settled at 10.18, 10.16 today. So here's the thing. I have a 10.16 settle, options expiring in 6 days. This future closed 11.05. Almost $1 over that number, 90 cents over. So what the hard part about VIX pricing, trading VIX, is all VIX options that you see price off the future as the active underlying. They don't use the cash. All the liquidity providers use the future as the underlying price. So if you're looking to trade VIX to expire next week, the underlying price today for that option, for those options, is going to be 11.05. If you want to trade VIX options to expire in 13 days, which is the V serial, that underlying price is 11.30. Even though VIX is 10.16, the options are all priced around 11.30, where the future is trading. This is the most frustrating thing for people that just are learning about VIX. So if you're buying a 10 put in VIX, what has to happen? Let's give you an example. If I'm buying a 10 put in VIX, what has to happen to this future in order to really make your 10 put move? So I'm buying a 10 level put, 13 days out, VIX future is trading 11.30. What has to happen to the cash? This future has to totally collapse for your put really to make some money. Even though when you look at it, if VIX is trading 10.16, that 10 level put, you would say, oh, it's only 16 cents away. But this future is the underlier. So when I look at this, just looking at a trade in here, okay, here's our serial expiration. Here's our 10 level puts, only worth 20 cents. Even though VIX is trading 10.16, this put is only 20 cents, but the call is worth $1.45. And you look at that and say, well, that's all screwed up. This call and this put should be around the same price because I'm trading almost at the money. How come that call is trading $1.40? That's because the underlying price for VIX is the future, and that's closer to 11.30. So the first thing you have to do if you want to trade VIX options is you have to get a handle on what the VIX future is doing for that term. Now, I'll give you a hint. What if nothing happens between now and December 20 expiration VIX? What if nothing happens? What's going to be the value of that future? Remember, if nothing happens, VIX stays the same, what's going to happen with the value of that future? The future that's trading 11.30 right now. Okay? It's going to drop to 10.16 because that's where it's going to settle. Well, that's the second question. Richard is saying the value of the future, the value of the straddle. What's going to be the value of the future, and what will be the value of the straddle? The future is going to go to 10.16. So if you're a buyer of that future trying to buy volatility, you're going to lose. If you paid $1, right now you just paid the offer, which would be $1.70 for the straddle, what would the straddle be worth? On expiration, the straddle is going to go to 0. Okay? That's what frustrates most people with this product. Right? Because even if VIX goes to 11, what's this straddle going to be worth? Because as you get closer to expiration, that future and that cash are going to do what? They're going to keep converging until, boom, they're the same on expiration. It makes it really difficult to trade these things. So if I did anything and maybe dissuaded you from trading this, is if you don't understand how it works, you have almost no shot to make this work right. Okay? And I guess I got to moderate this for the crowd a little bit because you guys mostly trade stocks. But what I've given you is kind of what I'd say is my guesstimate. Very convincing argument not to trade with. I like it because there's a lot of weirdness in it, personally, because I understand the weirdness. And the weirdness actually creates tremendous opportunities. But if you don't get it, you shouldn't trade it. So here's a couple of things. Steve probably just got 1,000 re-ups right now just on my webinar. Well, then I did my job. So, but to give you an idea, this is how things will move relative to cash, just so you know. So, if you have a future that's going to expire in around 1 day, well, this is what I'm going to get to in a little bit, Rick. So, a future with 1 day to expiration is going to move around 99% of whatever the cash does. Once that future gets to 29 days out, the future is only going to cover about 50% of what the cash does. Trading stocks with candlesticks is probably easy. But that's this product. So what I would say, Rick is saying, how to use VIX as an indicator of future market moves. You don't use the cash, Rick. What do you use? You use the futures. The way the futures are shaped is the indicator of future market moves, not actually cash VIX. Okay, so when I do my Easy VIX webinar, isn't it VIX Made Easy? It's funny, it's a 4-part webinar. Actually, after that webinar, after that series, you'll understand. So what I would say is the only way to trade VIX and understand is you have to understand how the futures. All these products, VIX options, VXX, UVXY, all these products, they all have different underlyings because they all trade the VIX futures differently. They all own the VIX futures differently. They all respond to the VIX futures. So all these products respond to the VIX futures. So you have to understand how the futures trade first, get the right duration of what you want, meaning the future that you're interested in, and then you go pick the product. So it's a process. Remember that at expiration, the extrinsic value is vaporized. That is correct, Paul. I like that term vaporized. Okay, so here you go. You see the guy pulling their hair out? Is that some of you in here right now? Steve, I just made your job easier for at least probably 6 months. So, understanding vol is just one part of the puzzle. In order to trade VIX options successfully, you actually have to know how to trade the futures. VVIX is just the volatility of the options. The calendar, understanding the calendar function, which is what I alluded to here, and the skew in VIX in general, basically that's just the explosion characteristic of the product. And what happens is, once you understand where those things are, you can optimize a VIX trade anytime. You might not like the trade, but you can pick an optimized trade. Right? And this is just an intro. So in my easy VIX class, or VIX Made Easy, that's what we do. So I guess, I don't know, do we sell our course, Stephen? Yes, I've totally freaked everybody out by it. But anyway, for 17 bucks, you get 3 parts of our full part series, and you get access to Option Pit for a month. Just because I think Mark likes Steve. There's the link. For 17 bucks, if you want to melt your head down, but you will understand how the product works and how to price things. And the first thing I do is actually help you learn what the term structure does with the futures, and that helps gives you an idea about market pricing. And I think it would help you for the swing trading, all the stuff you do in the candlestick. If anything, you're going to look at it and say, oh my God, the market is poised to move. Maybe I shouldn't be this short. Well, I'm glad. Has this helped? I think Steve makes these videos. I know we have clients. I have clients in our room that review videos 5 and 8, 10 times. And these are when I do one-on-one sessions. So, you know, that's what the content is for. I cover this in Platinum and Pro, Rick. So when I do Pro, I basically teach you how to trade the product. It's exhaustive, to be honest. But it's thorough. It's basically what I used to do to floor traders. You go through the same thing. You go through gold, you go through platinum, and then we do one-on-one stuff. So it takes about a year. So if you're into that, that's fine, but it's thorough. Any other questions? And the first thing I would tell you is if you don't understand the product, how it works, if you're comfortable doing the candlesticks, stay there. If you do well, stay there. If you don't, VIX is not something just to go jump off into the deep end with. That's my best advice after doing this for so long. Any other questions? You got links there. You'll be able to look at this if you choose. I think that's about it, unless anybody has any other direct questions. We will start our VIX Made Easy class next Thursday. It harmonizes. Well, the thing with trading volatility is you trade a range. You don't trade a direction. So what I teach people is how to set a range. That's the difference. Some people have an affinity to trading the direction. Other people like saying, I like it if the thing just goes up or down $5 and I still got a shot. And once you understand that, but it's a different way to think about it. Different cookie. It's dessert, but it's a different cookie. Also, if you have questions, you can send me a note, andrew@optionpit.com. But use the link that Steve put in there. The fourth part of the course is putting all the pieces together, Frank. So you have to subscribe to another month of Option Pit Live to get that. We'll give you 3 for 17 bucks. Any other platform than Thinkorswim? You could LiveVol or Thinkorswim. Those are the two that I use to look for things. That's what most of our clients use. So that would be the Lightspeed platform now. So I trade the VIX options, the futures, VXX, UVXY, and the SPX. That's in our fund. That's the majority, 90% of the fund, 95%. Lightspeed is LiveVol. That is correct. Anything else? I think Jim, the recording guy, I think we're done. If you have questions, just send me a note, andrew@optionpit.com. And the 197 package would be VIX Made Easy if you did not do this webinar. All right. So this gives you a shot at Option Pit Live for a month. You get 3 of the 4 sessions. All right. If you have any questions, let me know.
Andrew,